central bankers all around the world are dumping the currency that you print, right? Federal Reserve notes, right? They're Federal Reserve notes. They're notes of the Federal Reserve. That's what the dollars are. And all these other central bankers are dumping the notes of the Federal Reserve to buy gold. Gold is the canary in the monetary coal mine, right? The canary obviously is dropping dead, right? Gold is shooting up. It is a warning, but it's falling on the deaf ears of a FOMC that doesn't even know what they're hearing, or they can't hear it at all. They're oblivious. They're tone deaf because they don't even understand inflation or monetary policy.
Gold's meteoric rise in 2025 comes as no surprise, given the prevailing macroeconomic landscape that has created the perfect conditions for a sustained rally. Investors have flocked to the precious metal as a hedge against economic instability, cementing its status as the year's top Trump trade. At the beginning of 2025, many analysts labeled this the year of gold, and market trends confirmed that prediction. Since Donald Trump's return to the White House in January, gold prices have skyrocketed by over $300 in just 50 days, repeatedly breaking all-time highs. Veteran market analyst Peter Schiff sees gold's recent move beyond $3,000 per ounce as more than just a temporary spike. It signals a deeper transformation in the financial landscape. Unlike previous rallies in 2011 and 2020, which were driven by short-term market fears and speculative trading, this surge is underpinned by long-term structural shifts. Gold has solidified a strong support level of around $2,000 per ounce, demonstrating its resilience amid economic turbulence. Over the past 2 decades, the metal has outperformed major stock indices, reinforcing its reputation as a reliable store of value. Schiff argues that as the global economy faces mounting pressures, from soaring debt to declining confidence in fiat currencies, gold will continue outperforming traditional markets, drawing even more investors seeking stability. One of the significant forces fueling this rally is central bank gold buying, which reflects a growing distrust in the US dollar's long-term dominance. Nations like China, India, Poland, and Turkey have aggressively increased their gold reserves while reducing their exposure to US Treasury bonds. This shift aligns with broader de-dollarization efforts as more countries seek alternatives to dollar-based trade and reserves. The dollar's recent weakness has only strengthened this trend, making gold more attractive to international buyers. At the same time, U.S. trade policies and tariffs could accelerate this shift, as countries exporting less to America may find fewer reasons to invest in U.S. debt. With all these dynamics in play, gold's rise seems far from over, positioning it as a key player in the ongoing realignment of the global financial system. We present the clips of Peter's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Nobody said to Powell, hey, what do you think about $3,000 gold? Because on Monday, gold closed above 3,000 for the first time ever. It closed above 3,000 again on Tuesday. And again today, it hit another record high. It closed at 3,048. And it's up again the evening, another $5. So as I'm recording this podcast live on Wednesday evening here in New York, or I'm not in New York, but New York time, gold is trading in the spot market at $3,053.30, up $5. Nobody brought this up because gold is flashing a warning that the Fed is too loose. You know, in the Q&A, one of the reporters brought up Alan Greenspan's old definition of price stability, where Greenspan said, well, price stability is where businesses and workers don't even bother to calculate price changes into their plans because prices are going up so slowly that nobody really cares, right? So it's like indifferent in decision making. And he asked Jerome Powell if he would, ascribe to that definition and if he believes that we have price stability. And he did say, yes, I like that definition. But he really didn't answer as to whether or not he thought we had price stability, kind of dodged that. But the point I'm making in bringing it up is that Alan Greenspan also talked about the importance of gold in setting monetary policy. Alan Greenspan said that even though we're not officially on a gold standard, he said that he used the gold price as a reference, as a signal to let him know whether monetary policy was too tight or too easy. What Greenspan said was that if gold gets up to $400 an ounce, that means that he's too loose. If it goes below 300, that means he's too tight. So obviously, at the time that Greenspan made the statement, gold was probably around $350 an ounce. And he kind of looked at, if it was going above 400, I'm too loose. Maybe we got to tighten policy. But if the price of gold drops below 300, maybe we're too tight, right? We got to ease up. Well, of course, gold's 3,000 now, right? So that shows you how much things have changed. You know, I looked again at the chart going back to the beginning of this century. The S&P is actually down 60% if you price it in gold. I mean, that is an enormous bear market. And it really shows you that the entirety of the gain in the stock market is due to inflation. It's due to the destruction of the value of money, not a real increase in the value of the companies that are represented by the S&P 500, but that we are, measuring their value in rapidly depreciating currency. And it's not just the dollar relative to the euro or the yen or the pound, because all those currencies have gone down. And so it's a global inflation. It's not just an inflation in the United States. But Greenspan acknowledged that gold was an important market signal. And he even said, we're not officially on a gold standard, but it's kind of like we are because I'm using gold, right? So if gold goes up, I'm going to tighten, right? And so it's kind of like a gold standard, but it's not a gold standard. Well, what about now? What is $3,000 gold saying about Fed monetary policy? Well, apparently nobody cares. Nobody even wants to ask these questions. Not one reporter in that room. There was a reporter who asked Powell about the stock market and its decline, and if the decline in the stock market concerned him at all. But nobody asked him about the rise in the gold market and if that was concerning. You'd think you would ask the chairman of the Federal Reserve, hey, the price of gold keeps going up, and now it's at an all-time record high. It just blew through 3,000. Are you worried about that, Chair Powell? Are you worried that the gold market is saying something that maybe you've got your policy wrong? The fact that central bankers all around the world are dumping the currency that you print, right? Federal Reserve notes, right? They're Federal Reserve notes. They're notes of the Federal Reserve. That's what the dollars are. And all these other central bankers are dumping the notes of the Federal Reserve to buy gold. They are foregoing 4%, 4.5% interest on U.S. Treasuries in order to put gold in a vault and earn no interest. Are you concerned about that, right? Are you concerned that the markets are repudiating your policies, that the markets are telling you that interest rates are too low and that inflation is going to be too high? Nobody is even asking Powell, his opinion on that. I mean, I would love to hear his answer, although I'm sure, he'd find a way of weaseling out of it like he does for any question that he, either can't answer or is uncomfortable answering. But that is the reality. That is the real proof that the Fed is wrong, because you have a market that is saying that the Fed is too loose and that these rate cuts are a mistake whenever they come. The Fed should be hiking interest rates, not deciding when to cut them. And again, gold is the canary in the monetary coal mine, right? The canary obviously is dropping dead, right? Gold is shooting up. It is a warning, but it's falling on the deaf ears of a FOMC that doesn't even know what they're hearing, or they can't hear it at all. They're oblivious. They're tone deaf because they don't even understand inflation or monetary policy.
Peter Schiff highlights that surpassing $3,000 an ounce is not just a financial milestone, but a clear warning of the Federal Reserve's ongoing policy failures. While the central bank insists that inflation is under control based on select price index readings, the soaring price of gold suggests otherwise. Gold has historically been a reliable indicator of monetary stability, and its sustained rise signals deepening concerns about the dollar's long-term value. The Fed, however, remains fixated on short-term economic data, believing it can manage inflation with interest rate adjustments. Its strategy of waiting to assess the impact of President Trump's tariff policies before resuming rate cuts reflects a reactive stance rather than a proactive approach. The reality is that inflationary pressures are already mounting, and by the time the Fed acknowledges them, the damage may already be done. Despite its reassurances, the central bank appears blind to the warning signs flashing across global markets, with gold's record surge signaling that monetary instability is far from over. Peter asserts that the Federal Reserve misinterprets inflation by failing to recognize gold as a key indicator of monetary stability. While external factors like supply disruptions can drive temporary price increases, sustained inflation is driven by excessive money creation. Gold's long-standing role as a store of value makes it a reliable measure of inflationary pressure. A rising gold price signals declining confidence in the dollar, yet the Fed continues to overlook this warning, increasing the risk of policy missteps and economic instability.
All Powell looks at when he gets all these questions about inflation, he always responds that, he wants to look at the prices and determine, why the prices are rising. Is it going to be transitory? It's hard to believe they're even using the word transitory again, but, is it going to stick? Or, he's all focused on prices. But prices going up are a result of inflation. You can't just focus on prices. It's like driving in the rear view, looking in the rear view mirror. You're going to get into an accident. It's the money supply expanding, which is continuing, and credit, right? Inflation is not just the expansion of the money supply. It's an expansion of credit, because credit can be used as money. You can buy stuff with credit even if you don't have any money, right? And so the more credit there is in the economy, the more upward pressure there is on prices. So you have to look at the money supply and the credit supply to know what's going to happen to prices in the future. If you're just looking at prices and you're ignoring all that, you're not going to fight inflation. And in fact, if you're saying, I'm going to wait until I see a sustained increase in prices before I do something about inflation, well, then you're too late. You have to be preemptive. You have to understand how the monetary aggregates are ultimately going to impact prices. There is a lag. That's why they say, don't let the inflation genie out of the bottle. By definition, if you do what Powell says he wants to do, wait until you see that prices are really going up, right? Looking through the impact of tariffs, because a lot of the discussion was, well, the tariffs, and how do you know if the price increases are a one-off event by the tariffs or if it's something more? And a lot of times too, when Powell talked about that inflation was a bit higher, he always attributed it to the tariffs or the fear of the tariffs. When prices were going up even before we had the tariffs. But of course, he's trying to, pre-blame any inflation on the tariffs. I mean, I know this is going to happen, right? Anything that happens, he's going to say, well, I guess it was the tariffs, right? That's how the Fed is going to deflect the blame from its own monetary policies and put them onto the tariffs. That's another reason why Trump shouldn't have done it, because it gives the Fed an excuse and it lets them off the hook, because it's very easy to blame the inflation on tariffs. But if Powell does what he says, just really waits until he can figure out whether the price increases are transitory or whether it's more permanent, by the time he figures that out, it's much too late to do anything about it, right? Because, the prices are really going. So his whole methodology of waiting for inflation to become a bigger problem before he tries to solve it means that, he can't solve it because of the lags. And of course, it doesn't even matter anyway. Inflation is already going to be much higher based on the mistakes that have already been made. The credit supply has been consistently growing throughout the entirety of the rate hike. And then, of course, the Fed stopped hiking. Money supply is growing. Now they are shrinking the balance sheet less, which is also going to end up being inflationary. And now the dollar is weakening. And one of the main reasons that the CPI retraced was the strength of the dollar. It was the dollar moving up that brought commodity prices down. Well, commodity prices are now rising, and they're going to rise even faster now that the dollar is falling. So the temporary effects of lower inflation are going to be gone. That's what was transitory. It was the dip in inflation that was transitory. That was a transitory decline in inflation. And now inflation is going to resume its acceleration, and it's going to be particularly fast because the Fed is not doing anything to put on the brakes. And in fact, the Fed is still planning on cutting rates. And again, that was also why I thought, and even the markets would probably agree, that this was dovish, in that Powell had to acknowledge that inflation was going to be higher. In fact, they increased their forecast for inflation this year from 2.5 to 2.8.
The relentless rise in gold prices underscores the urgency for a stable monetary policy that moves away from the Federal Reserve's discretionary approach and toward a gold price rule. By targeting a range between $2,900 and $3,100 per ounce, the Fed could restore confidence in the dollar and curb inflation without resorting to interest rate manipulation, often leading to economic disruptions. A rules-based system tied to gold would directly address monetary instability, rather than relying on reactive policies that create uncertainty. If gold continues its upward climb, inflationary pressures will only intensify, leaving the Fed with limited options. Its likely response, restricting economic growth to combat inflation, will trigger political resistance and deeper scrutiny of its role. That's it for today. Share your thoughts on Peter's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video.